Okay, so our next area is financial markets and types of securities. MCQs, this area was missing there. Which of the following economic functions is provided by the security markets? A marketplace in which efficient and inefficient and expensive investment transactions take place. This is inappropriate word. Rather, what we should be looking for, a market in which efficient and inexpensive investments transactions take place. The transaction cost should be low. So this is basically incorrect statement. Unstable security prices because of frequent price changes. Unstable security prices, again, this is not a good economic function of security markets, so that's why it is incorrect. A small number of transactions, no, you would find a large number of transactions in the security market. So A, B, C are incorrect. Then what is the right economic function provided by the security markets? Facilitation of issuance and purchase of new securities. Yes, want to issue or purchase new securities, the financial market, the security markets should assist you, should provide you help. That's why D is the right option. Moving on. Which of the following is not true? Mind the word not true about the financial markets. Let's see one by one. Financial markets are the total supply and demand for the securities. This is true statement. I'm writing T in front of it. Financial markets facilitate borrowing and lending of financial assets and obligations. This is true as well. In perfectly competitive markets, financial intermediaries act as price setters to clear the market. This is absolutely wrong. Financial intermediaries, they do not set the price. Rather, the participants in the market who buy and sell, they are the one through their purchase and sale. They are the one who effectively set the market price through their transactions. So this is not true. Then of course D has to be true. Financial markets change over time. True. Causing people to adjust their pattern of consumption. Yes, with the passage of time, the markets do change, and then the users or the participants, they will have to change their consumption accordingly. That makes sense. Question number 3. The financial markets that trade debt securities with maturities less than 1 year are dealer-driven market. And what kinds of markets are there? Remember, we discussed this in our overview, that the securities that have less than 1 year maturity, the markets in which we trade them is called the money market. Money markets involve those securities that have maturity of less than 1 year. Common treasury bills, T-notes. So that makes D to be the correct option. Other A, B, C are not correct. Similar question to that one, just done. Which of the following financial instruments can be traded in the international money markets? Remember, money markets, so we are looking for those instruments that have maturity of less than 1 year. Mortgages up to 30 years, not a money market instrument. Preferred stock is a capital market instrument. Government treasury bonds could be up to 5 to 30 years of maturity. So what you're talking about is the money market instrument that has maturity of less than 1 year. So that is clearly the government treasury bill, and that's what makes C to be your correct option. Moving on. In capital markets, the primary market is concerned with the provision of new funds for capital through capital markets. When we say capital markets, we're talking about new bonds. We're talking about new stocks. Since primary market, remember, primary capital market, it's where the instruments come for the first time and they're issued in the initial public offering. So new issue of bonds and stocks, they come in the primary market. Once they are issued, then they are traded in what you call the secondary market. So look no further. New issues of bond and stocks, that's what we trade in the primary market. Moving on to next question. Question number 6. If a multinational firm were to raise equity capital on the London Stock Exchange, this would be referred to as what? You are issuing equity securities, remember, and it is not a money market transaction because equity is forever. Equity capital is a long-term finance. It cannot be in the money market. Since it's issued for the first time, it's an IPO, it is the primary market transaction. Once the shares have been issued and now the different participants in the market, they buy and sell and they purchase, would be then the secondary market transaction. So it is the primary market transaction, and that makes B to be the correct option. And it's not secondary transaction, it is not a mortgage market transaction, so clearly B is the right option. Then we have question number 7. Over the counter market, OTC, is what kind of market? It's an auction market where trading takes place at a particular physical sites like New York Stock Exchange. Wrong. This is not an OTC. Rather, OTC is a market that is linked by telecommunication equipments. It's a digital market for dealers. So this is not true. The dealer market where brokers and dealers are linked by the telecommunication equipment to trade securities. NASDAQ is the example of OTC market. So that's B, in fact. Then an auction market. Auction market is not an OTC. A dealer market that trades securities on the stock exchanges due to high dollar volume of trade. Not necessarily high dollar volume. So that makes B to be the correct option. Alright. The market for outstanding listed common stock is called outstanding. When we say outstanding, it means these are the shares that have already been issued and now they are with the general public, and these shares are not trading in the market. So it is not clearly a primary market. It is not the new issue market. It is not the OTC market. Rather, it's the secondary market where the already outstanding issued shares are being traded. All you guys are right. So that makes D to be the correct option. This is an interesting question, gentlemen. I need your attention. It says, which of the following is the financial intermediary? Important question. Apparently, it looks that money market is intermediary, stock exchange is intermediary, OTC intermediary, that is facilitating transaction between the buyers and the sellers. No, gentlemen, ladies, please listen. When we say a financial intermediary, what we are talking about? We are talking about an institution who takes in deposits from you or investments from you, issues its own securities to you, and uses your funds to make investments in other avenues, in bonds market, in the property markets, or maybe in the equity market. So yes, absolutely, Noman, it's mutual funds. Mutual fund is a financial intermediary, takes in deposits from you, issues the units to you, and then uses your money to make investments in different investment opportunities. Right? So these money markets, and these are market participants, not the intermediaries. Okay, now this is a good question, gentlemen. The treasurer of a major multinational corporation needs to borrow 50 million to finance new production facility. That's what you need, a lot of money. What you're doing, the treasurer is deciding between the direct financing or the public offering. Either to ask for someone to invest directly in this project or go for the share issue. These are the two options. Alright. All of the following statements in regard to these two alternatives are correct except. So out of these 4, 3 will be correct and 1 would be the incorrect, and we are to look for the one that is incorrect. Let's read one by one. The rating assigned by the Standard & Poor's, Moody's, there are big, these are the 3 big, Standard & Poor's, Moody's, or Fitch. It is critical in pricing public debt. This is true. This statement is true. When you issue bonds to the general public debt, the ratings given by these rating agencies is very crucial for you. This rating will determine the price of your bonds. It's the right statement, true statement. Private debt is issued to sophisticated investors such as insurance companies. This is true as well. So there's a difference between private and public debt. If I want to bring bonds and I want to sell to you, Suji, Shamsu, you, Najaf, Navneet, to you guys, so this would be a public debt offered to all who are in the market. But a private debt would be bonds, but they would be issued to some sophisticated investor like Vivek. Vivek is an investment banker, or maybe he's an insurance company, and I offer my bonds directly to him, not offering to the general public. This is called private debt. So this statement is true as well. Private debt is issued to sophisticated investors, or I would call this, I love this term, institutional investors. I would call it institutional investors. A beautiful term. Institutional investors mean these are the investors, but they are themselves an institution, not individuals. Insurance companies, investment banks, or hedge funds probably. So this is a true statement. Then public debt tends to have higher interest rates because of its lower liquidity. This is a false statement. And why is it false? Public debt tends to have lower interest rates because of its higher liquidity. The terms are totally in opposite arrangement. Public debt tends to have lower interest rates because of its high liquidity. So the term is totally misarranged, and that is why this statement is false, inappropriately worded. And that's what we were looking for. So C is your right answer. And why not D? We should have a good reason for rejecting D. Public debt, since it's being offered to the general public, needs to be registered with SEC. True. And it's a time-consuming and costly process. Absolutely right. And I'm sure you would have read in your theory that unless you need a lot of money by issuing bonds, only then you should go for bond issue. Remember, if you need 5 million, 10 million, go for the bank loan, short-term running finance for short-term. But if you need funds for longer period and a large amount of fund is needed, then go for the public debt, because it's a time-consuming and costly process. So this is a true statement as well. So the incorrect one was option C, and that's our right answer. Moving on, question number 11. The strong form of efficient market hypothesis states that the current market price, we have learned the efficient market hypothesis. There are three market forms: weak form, semi-strong form, and the strong form. So when we say strong form efficient market hypothesis, it means all public plus private information is reflected in the stock price. All publicly available information, that is called the semi-strong form. Incorrect. All information, whether it's public or private, yes, that is the strong form. That's the strong form, and that's your right answer. And only the price information in the past price movement, this is called the weak form. Gentlemen, it's a good question that covers all the aspects of your efficient market hypothesis. If only the information found in the past price movement, this is the weak form of efficient market hypothesis. If all the publicly available information is reflected in the stock price, this is called the semi-strong form. And if all information, whether it's public or private, it is called the strong form. So you will have multiple questions of this type and you will get a fuller understanding. So don't worry. Question number 12. The semi-strong form, we just discussed, semi-strong form is that form of the efficient market hypothesis where only the publicly available information is reflected. So the semi-strong form of efficient market hypothesis states that the current market price reflects what? No pertinent information, irrelevant. All pertinent information, that will be strong form, which is not what we're looking for. Only the information contained in the past price movement, that would be the weak form. And then of course finally semi-strong form, only publicly available information. That makes it perfectly to be our right option. D is the right answer. Only the publicly available information. Moving on. The weak form of efficient market hypothesis we have just discussed states that the current market price of the securities, they just reflect all the past price movement. The markets that are very inefficient, they will only reflect the past price movements. The markets that are semi-strong, they will reflect all the public information, and the markets which are strong form efficient, they will have all the public and private information. So right here we needed the weak form efficient, so that would be A as your correct option. Moving on. Moody's, Standard & Poor, Fitch, these top three rating agencies, their debt ratings depend upon what? When they rate debts, what basically they look for? What basically is the criteria? Yes, they do consider the size of the company. They do consider the size and the type of the issue. They do consider the firm industry, but eventually their ratings, when they give the AAA rating or when they give the BBB rating or BB negative, these ratings eventually depend upon the chance of the default. The companies that are less likely to default will have a high rating. The companies that are more likely to default, that will have low rating. Absolutely right. So they got it correct. That's A. Moving on. If a firm is rated below BBB, that's alarming. Below BBB means it is more likely to default. Now most of you will jump for a zero coupon bond. A zero coupon bond means it pays no interest, but when it will mature, it will pay you enough. So having a zero coupon bond doesn't mean it is rated below. No, not at all. So don't go for that. An investment grade bond normally has rating of above BBB or sometimes AAA. A junk bond, a bond that is likely to default, is rated below BBB. Absolutely, that makes. And an income bond pays interest based upon the income earned by the issuer. So basically it's not necessarily rated badly, it's just that it pays interest based upon the income earned from specific sources. So for us, this is the answer. A junk bond is a bond that is rated below BBB. This is unlikely that you people will be asked on the specific bond ratings. The BBB represents what, AAA represents what. It's just that the question Gleim has added to make a point to make you understand the impact of ratings. Otherwise, we are not required to go for the specific ratings. Otherwise, the ratings criteria and all these three rating agencies, they have different rating, different criterias and different labels that they use for grading the bonds. So that would be quite complex. That's why IMA doesn't expect you to know the exact ratings symbols that are used. Alright, next. Which of the following below best describes a public offering where there is less price uncertainty due to existence of benchmark price? What we're looking for here is that which of the following best describes a public offering where there is less price uncertainty. We are not worried about what the price is going to be. If the company is already listed and company brings in any subsequent or secondary offering, like let's say a company share that is already trading at $50. When we bring in new shares, we would know what the likely price is going to be. Of course, we will underprice the shares a bit, maybe to make investors invest more. Maybe we might price it at $49 or maybe $48. So that will be an indication that there is less price uncertainty because we already know what the price is in the market. So we will price these shares somewhere close to 50. Now, what is the difference between subsequent and secondary? Gentlemen, ladies, pay full attention. Let's say I have 100,000 shares outstanding. Out of these 100, I purchased 20,000 shares. These shares are called treasury stock. Most of you, mashallah, have qualified part 1. You would know when the company purchases its own stock from the market, these stocks are called treasury stock. Right? Now, listen. Now company wants to sell some shares. If the company sells the shares from the existing treasury stock, existing treasury stock which the company purchased from the market, it is called the subsequent offering. Or if the company issues totally fresh shares, because company has an authorized capital of 500,000 shares, and if company issues shares from this bunch, maybe issues 15,000 shares, this is called secondary. Gentlemen, this is a very fine point which you need to understand. When the company issues shares from the treasury stock, which were the company's own stock purchased and held with the company, out of these shares, when we issue new shares, they are these shares, treasury stock, issued to the general public, it is called the subsequent offering. And when the totally new shares out of the authorized shares are issued, it is called the secondary offering. So that's the point here. If your shares are already in the market, selling for $50, you already know what the price is, so you might set it 49, 48. So whether it's a secondary issue or subsequent issue, you have no problem at all. Right? So that makes B to be your correct option. Okay, it's a good question. Confidential negotiations between company A and company B were completed. Remember, confidential. There is some element of private information. So confidential negotiations between company A and company B were completed when? Completed this morning. It was decided in 1 week it will be publicly announced that the company A will acquire company B for a cash offer of 30% premium over the company B's current market price. Now this is a very interesting question. There is some confidential negotiation between A and B. A is going to acquire B for a price 30% above the market price. This is clearly a private information, and if you have this information, Noman, you are going to make a lot of money. Using this private information, if you make a lot of money, and if you are in the US, expect 20 years jail term. If anyone who uses the private information to make an insider trading, the law in the US is extremely stringent. You are in hot waters if you do that. Now, if the stock price of the company B does not react at all today but rises by 30% with the public announcement next week, this would imply what? Very good question. Since this information was privately held and no one in the market knew, the share price did not react at all. The share price reacted only when this information was made public. So what does this tell about this market efficiency? Since in this market only publicly made available information reflects or affects the share price, privately held information is not being used or it's not reflecting on the stock price. This means this is a semi-strong form efficient. Remember, we have three types of market efficiency. One is the weak form, where only the past price movement reflects in the stock price. Then we have the semi-strong form, where only the publicly available information affects the share price in this case. And then we have the strong form. Strong form means whether public or private information is immediately reflected in the share price. If this question involved strong form efficient market, you know what would have happened? When the confidential informations were interacting between A and B, and there was no involvement of any disclosure of information, but immediately on the same day, share price would have went up by 30%. That means the market is strong form. Private information or public information, khalli wali, it is totally reflected in the share price. But here what happened? There was no reaction in the share price, and share price only went up when this information was made public. So which means here the share price is only influenced by the public information, not private. So this means it's semi-strong form efficient but not strong form efficient. So that makes C to be the correct option. Okay, moving on to question number 18, which is, which of the following statements is not correct? Let's mark it. Not correct with regard to initial public offering. Not correct. In best efforts offering, the underwriter has no obligation to purchase unsold stock. Yes, in best effort offering, the underwriter will only make his best effort. Whatever he can sell, fine. Whatever he cannot sell, he is not liable to purchase it. This is a true statement. True, perfectly true. In an underwriting offering, the underwriter has an obligation to purchase all unsold stocks. Yes, in best offering, you are only obligated to sell whatever you can, rest for which you are not responsible. But in underwriting offering, you are undertaking that in case the sale is not made, I will be responsible to take on all the shares. So this is a true statement as well. C. Best efforts offerings provide the firm with the greater assurance that all offered shares will be sold. This is incorrect. Not best offering, rather underwriting offering. Underwritten offering provides the firm with the greater assurance that all offered shares will be sold, because if they are not sold, then the underwriter is obligated to purchase them. So this is the incorrect statement, hence our right answer. It's a false one. Okay, what about D then? More risky stock offerings are done on the best efforts basis. True, because the investment banker, he is not going to take the risk. He will only try to make as much effort as he can, otherwise he is not made liable to sell these risky shares. This is a good question. Question number 19. An analyst is in the process of reviewing the following information on a publicly traded toy manufacturer. Share price for the last 20 years. This is made available to him. 10Q filings for the last 5 years. Remember, there are certain regulatory filings with the Securities Exchange Commission in the US. So one of those is 10Q and 10K. They are studied in detail in CFA level 1. What basically 10Q and 10K means. Just remember, this is the information related to company's financials. The difference is that 10Q is submitted quarterly, 10K is submitted annually, but the information contained in them is the same, the financial statement. So in other words, you can say that these are the informations filed with the SEC. And then the fourth one is the website for the toys company. So this is clearly all information that is in the public domain. Nothing private here. So what we are looking for, the above collection of data is an example of which of the following. Let us be very clear on this. This is public. 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 Right? So to that extent, answer, you're right that they are all related to the past. So only the past is affecting, but remember, it is also publicly made information available. Website for the company would contain newest and the most recent information. So you can say that the past and present, they are both available in this situation, and clearly they are all related to the information available in the public domain. Right? All of them are available in the public domain. So the above collection of data is an example of which of the following. I can't say strong because there is no indication regarding private information. So it is not strong form efficient. Semi-weak form of capital asset pricing theory, a ridiculous statement. There is no such thing. Now we are confused between A and B. Look at this. Semi-strong form of the efficient market theory. Weak form of the capital asset pricing theory. So there is no such capital asset pricing theory. So it's going to be then semi-strong form of efficient market theory or the efficient market hypothesis. So that makes A to be the correct option. Right? So this was A. So good question. Clearly a very nice one. Here we go. A treasurer of a European company plans to raise 500 million to finance its business expansion into the Asia Pacific region. The treasurer is analyzing initial public offering. All of the following are correct except, let's mark that. So out of these four, 3 will be correct and 1 will be incorrect. We need to look for the one that is Not correct. So let's just bring these in focus. Let's read first A. Under an underwriting offering, the investment bank will guarantee the sale of stock at an offering price. However, the commission charged to the company will be higher compared to a best efforts offering. Absolutely. Because since the underwriter is taking a risk, he must be compensated for taking the risk. Beautiful question, gentlemen. See, there are two types of, I am an underwriter, investment banker. I can offer two types of arrangements. First is the underwriting offering, where I commit that whatever I can sell, I will sell. Whatever is not sold, I will buy this. Since I'm taking risks, I'm going to charge higher cost. In the best effort offerings, I will try my level best to sell as many as I can. Those stocks that remain unsold, I'm not responsible. Since I'm not taking risks, so my reward is going to be low. So this is a perfect statement. It's a true statement, by the way, that since in the underwriting offering, commission will be higher because the underwriter is taking risk. So A is correct, true. An initial public offering will increase the liquidity of the company's stock and establish company's value in the market. This is true as well. When IPO is issued, the share price is stabilized in the market, so that would help companies gain liquidity and establish the company valuations. True statement. One of the advantages of an initial public offering is that stock price can accurately reflect the true net worth of the company after it goes public. This is debatable. One of the advantages of IPO is that stock price can accurately reflect the true net worth. This is not true. Even the IPO may set the company valuation, like in this part, establish the company's value in the market. But it doesn't mean that the value is accurate, because there are many intangibles which may not be valued by the market. So saying that when the company goes for an IPO, the stock price can accurately reflect the true net worth, this is debatable, or rather quite a misleading term. Not possible. IPO doesn't accurately reflect the company's price. This is an incorrect statement. Then what about D? It is necessary for the company to file a registration statement with the SEC if it decides to launch initial public offering. It makes perfect sense. You cannot issue shares unless you first file a statement with the SEC telling them your intention, what you want to do. So this is true. So what was wrong is C. Question 21. In the market with the semi-strong efficiency, which means semi-strong efficient means only information available in the public domain is reflected in the share price, still some people have the private information which they can make to generate gains. So investors use historical prices to predict market performance. That is weak form. Security prices reflect all public information. That's perfect. That's what you call the semi-strong form. That's the correct statement. Security prices reflect insider information. That would be the strong form, because in strong form, public as well as private information is reflected in the stock price. Insider information is also, this is strong form. So clearly that gives you B to be the correct option. A group of investment banks working together to offer new stocks to the public is called a syndicate. When the share issue is large, a single firm doesn't want to take the risk. So many firms or investment banks together do the deal. This is called an investment banking syndicate. One of them will be the lead banker and rest of them will follow suit. So this is clearly. What is hedge fund? Hedge fund is a loosely regulated investment activity. Like for example, I am expert in managing investments. So I ask some people, rich people, high net worth individuals to invest their money and I will generate a much higher return than the market. Right? So these are the private individuals. They have invested with their own choice and I can manage their funds and use my experience to generate returns. So such a fund which is managed privately for rich individuals, high net worth individuals called hedge fund, and it is not tightly regulated because it's a private arrangement between ABC and me, so the law doesn't have much say in this. This is called a hedge fund. Rest of it, carve out, equity carve out, the share of a company's stock to the third parties. Spin-off is when a company is broken down to smaller parts. So the correct option here is the investment syndicate. Means when an issue is large, many large investment banks, they combine and do this activity together. Here we go. See, an underwriting syndicate is the combination of investment banks, not rating agencies, not leasing companies, not factoring company, rather investment banks, they join together. Okay. The question says underwriting spread refers to what? Underwriting spread, let's say if I am the investment banker and I want to I want to sell shares of Suji, he is listed now. So I will purchase the stock at 25 from Suji and then sell it in the market at 28. So the price between what I pay to Suji for the shares and what I am selling it in the market for, this is called the underwriting spread. This is called the underwriting spread. You just need to look for the options that match with this arrangement. A commission percentage, not a commission percentage basically, a discount investment banker receives on security they purchase from the issuing company. Not a discount, basically you purchase it at 25 and sell it at 20. So the difference between what you pay to the issuing company versus what you sell it to the general public for. So it's going to be C, the difference between the price the investment banker pays for a new security and the price at which the securities are sold. This is what you call the underwriting spread, right? So that is C. All right, next. Which of the following factors is characteristic of efficient market hypothesis? Not characteristic. Let us do it one by one. Accounting changes do not influence the stock price. Why? Because the stock price is valued based upon the company's fundamentals, not on accounting policies and accounting conventions. So this is a true statement. Capital markets prices reflects underlying value. What is the underlying value of the company's stock? Capital market will price that company's shares accordingly. This is a true statement. Investors are knowledgeable. That is one of the assumptions of efficient market hypothesis. So this is true as well. Then what? Financial managers can benefit from timing the sales and purchase of securities. This is insider trading. You use inside knowledge to make gain by selling your company's own stock or buying your company's own stock. So this is insider trading, and this is clearly not one of the characteristics of efficient market hypothesis. This is insider trading. That makes A to be the correct option. Question 26. The efficient market theory implies that security prices are not a good estimate of future cash flows. In fact, they are. Your securities are priced based upon the present value of the future cash flows, which you call the dividend discount model. So this is not true. Security prices are fair and a reflection of all publicly available information. This is true. The efficient market theory implies that security prices are fair and a reflection of all publicly available information. It's a correct statement. Not the best benchmark for corporate financial decisions. In fact, it is. We use the future cash flows, present value as the price of the stock. Always less than the fair value. Not always. It would lead to the fair value. Equal to fair value. Not always less than. Sometimes could be more than the fair value currently prevalent in the market. So this is incorrect. So the correct statement is B, fair and a reflection of all publicly available information. Question 27. The efficient market hypothesis states that it is impossible to obtain abnormal return consistently either I hope you remember from technical and fundamental analysis. There is no diagnostic analysis, no diagnostics, just that technical or fundamental. So if you read the statement, the efficient market hypothesis states that it is impossible to obtain abnormal returns consistently either through technical analysis or fundamental analysis. That makes B to be the correct option. Question 28. Stacks Incorporated recently had its bonds rated by Standard & Poor's for year 2. In year 1, the rating agencies classified the bond as AA in year 1, remember. However, in year 2, the rating of these bonds was downgraded to A negative. That's in year 2. What does this imply for Stacks Incorporated? It impact you. Stacks is less likely to default on the debt. Wrong. It is more likely now. It is more likely because it's downgraded, so it is more likely to default on its bonds. B. Stacks will pay more in interest costs. Since the risk has gone up, now the required rate of return by the investors will go up. Now you may ask and you may argue, sir, the interest rate on the bond is fixed. I agree. I absolutely agree. Rate is fixed, 6%. Right? And let's say the bond has a face value or the nominal value of 1,000. So 6% of 1,000, that's $60, right? Since your bond has been downgraded, if you calculate the effective interest cost, you are paying $60 on a bond that has a market price of $10. Why the price has fallen? Because it has been downgraded, so the price of the bond has fallen. So if you calculate the effective interest cost, that is much higher than what you thought. So 60 upon 810 times 100. Look at this. It is 7.4%. So effectively, you are paying more interest cost. More interest cost. I'm not saying more dollars. You are paying $60, but the interest cost is more because your bond has fallen in the market to 810. You are paying $60 on a bond that is trading at 810. So the effective cost of interest has gone up. That makes B to be the correct option. Why not C? Stacks interest cost will remain the same. No, it won't. Stacks bonds are now classified as junk bonds. This triple A negative rating doesn't mean junk bond. For that, the rating has to be below triple B. So this is again incorrect. Let us twist this question for better understanding. Let's say the bond rating went up. If the bond rating went up in year 2, in that case your interest cost will be lower now because your bond will become pricey in the market. Maybe it will sell at 1,030. Now look at the cost now. The cost will fall. 60 by 1,030. Now it's just 5.8%. See, that's the good thing. So if your rating goes up, your effective interest cost will fall. But if your rating goes down, your effective interest cost will go up. So that's the opposite arrangement you need to remember. Next we have the CEO of XYZ Incorporated bought 500,000 shares of treasury stock for $5 per share in year 1. What is next? During year 2, the CEO decided to sell 100,000 shares of treasury stock when the shares were selling for $6 per share in the market. What type of offering is it? I just told you a little while ago. If you are selling shares out of the treasury stock, it is called subsequent offering. But if you are issuing fresh shares out of your authorized shares, it is called secondary offering. So in this case, since the shares are being issued out of the treasury stocks are the stocks which you purchased from the market. So in that case, it's going to be a subsequent offering. All right, so which of the following entities is most likely to assist investors in assessing the default risk of a specific bond? So which of these market participants will tell you that this bond is going to default? Bond dealers, they will tell you every bond is good, buy, buy, buy. Investment banks, they will push the bonds on your head, they will sell more. Credit rating agencies, these are the agencies that assign ratings to the bonds, which is in fact very helpful for me to decide which bond should I purchase or which I shouldn't. So that makes C to be the correct option. All right, then we have money market funds generally invest in all of the following except. We just discussed that money market funds will invest in those investment opportunities where the instruments have maturity of less than 1 year. Commercial paper, AAA corporate bonds. Commercial paper clearly has a maturity of not more than 270 days. So here, yes, I will invest here. Certificate of deposits, yes, it's a money market instrument. Bankers acceptance, yes. So all these three, they are the money market instruments. So where they will not invest is the corporate bond, which has a maturity of more than 1 year. So absolutely, you're right, Naman. So it's A where I won't invest because it is not a money market instrument. So B, C, D, R, and that's why A is our right answer.